Look at your screen right now. I need you to focus. What you're about to hear in the next few minutes is not theory, it's not speculation, and it's not designed to scare you. This is raw market data that Wall Street is desperately trying to bury before the mainstream catches on. Today is January 3rd, 2026, and in the last 72 hours, something happened in the silver market that hasn't occurred since 1980. The last time we saw numbers like this, the Hunt brothers were trying to corner the entire global supply, and the government had to step in to change the rules mid-game to stop them. But this time, it's not two oil tycoons from Texas making a play. This time, it's the banks themselves. The very institutions that have spent 4 decades suppressing the price of silver are now turning on each other in a cannibalistic feeding frenzy. And the prey they're devouring? Each other's physical inventory. I'm going to walk you through the forensic evidence that proves beyond any doubt that the silver market just entered its terminal phase. We're going to examine the COMEX delivery data that shows a 46-year record being shattered. We're going to expose which major bank just hemorrhaged over 3 million ounces in a single session. We're going to reveal why every major online bullion dealer is completely sold out with restocking dates pushed to March. And we're going to show you why the vault inventories in both New York and Shanghai are on a collision course with zero. By the time you finish reading this, you will understand that the repricing event we've been warning about isn't coming next month or next quarter. It started 72 hours ago, and if you're not positioned correctly right now, you're already too late. Let me give you the headline number first, then we'll unpack what it means. On January 2nd, 2026, the COMEX processed 1,168 delivery notices for physical silver. Each contract represents 5,000 ounces. That's 5.84 million ounces demanded in a single trading session. But here's where it gets absolutely insane. When you combine that with the delivery spike we saw on January 1st, the total number of contracts standing for delivery in just the first 2 trading days of 2026 is 3,446 contracts. Let me translate that into ounces for you, 17.23 million troy ounces in 48 hours. To put that in perspective, global silver mine production is roughly 830 million ounces per year. That works out to about 2.27 million ounces per day. What we just witnessed was demand for 7.6 days worth of global mine production compressed into 48 hours. This isn't normal market activity. This isn't industrial hedging or routine commercial flow. This is a coordinated assault on the physical inventory of the COMEX exchange by entities that understand exactly what's happening and are moving with lethal precision to secure metal before the window slams shut completely. Now, why does the timing matter so much? Why January 2nd specifically? Because January 2nd was the first full trading day after China's export restrictions officially went into effect. For months, we've been tracking the legislative process in Beijing. We've been watching as the Chinese government slowly tightened the noose around silver exports. And on January 1st, 2026, those restrictions became active law, not recommendations, not guidelines, enforceable legal restrictions with criminal penalties for violations. What this means in practical terms is that the roughly 200 million ounces of refined silver that used to flow out of China annually to feed global demand has been cut to essentially zero. There are narrow exceptions for pre-approved contracts, but the application process is deliberately cumbersome, and the approval rate is rumored to be less than 10%. China has effectively nationalized its silver supply. They're keeping every ounce for domestic consumption, for their solar panel industry, for their EV battery production, for their 5G infrastructure, and for their strategic reserves. The spigot that the Western world has relied on for decades just got welded shut. So what did the sophisticated players do? Did they wait to see how the export ban would play out? Did they hope for the best? Absolutely not. They looked at the calendar, they saw January 2nd approaching, and they executed a full-scale raid on the only remaining source of easily accessible silver, the COMEX registered vaults. These players knew that once China locked down, the 39 million ounces sitting in COMEX registered inventory would become the last pool of liquid silver on planet Earth that could be accessed without paying extreme premiums or waiting months for delivery. So they didn't hesitate. They smashed the buy button with unprecedented force, and the delivery data proves it. Now let me show you something that's going to make your jaw drop. I have the actual issuer and stopper report from the CME right here. This is the document that shows who delivered the silver and who took delivery. And when you look at the names on this list, when you see which banks were on which side of these transactions, the entire narrative of the silver market gets flipped on its head. For years, the conventional wisdom in the precious metals community has been that the big bullion banks, JPM, Citibank, HSBC, Bank of America, they're all working together in a cartel to suppress the silver price and protect their collective short positions. And for a long time, that was probably true. They had a gentleman's agreement. They would coordinate their selling to cap rallies. They would pass contracts back and forth between each other to create the illusion of liquidity without actually moving metal. It was a coordinated suppression scheme, but that cartel just shattered. The alliance is broken, and what we're seeing now is not banks versus retail investors. It's banks versus other banks. It's financial cannibalism. Here's what the data shows. On January 2nd, the largest issuer of silver, meaning the entity that was forced to deliver the most physical metal against contracts, was Deutsche Bank. Deutsche delivered 1,280 contracts. That's 6.4 million ounces in one day. Now, to deliver that much silver, Deutsche had to either pull it from their own vault inventory or go into the open market and buy it at whatever price necessary to fulfill their obligations. Either way, it's devastating for their position. But here's the kicker. Who was on the other side? Who was demanding delivery and forcing Deutsche to bleed out their inventory? The largest stoppers, the entities taking delivery, were JP and Citigroup. JP alone stopped 880 contracts, which is 4.4 million ounces. Citi stopped another 320 contracts, or 1.6 million ounces. Combined, these two banks absorbed 6 million ounces of the 6.4 million that Deutsche was forced to deliver. Think about what this means. JP and Citi, who supposedly have been on the same team as Deutsche for decades, just executed a coordinated attack to drain Deutsche's silver reserves. This wasn't a market transaction. This was a hostile takeover. This was a bank run, and Deutsche Bank was the bank getting run. Why would they do this? Why would former allies turn on each other so viciously? Because the game has changed. In the old paradigm, when Chinese silver was flowing freely and when mine supply was meeting demand, the banks could afford to play nice with each other. There was enough silver to go around. They could all maintain their short positions, collect their fees, and manipulate the price without anyone getting hurt. But we're not in that paradigm anymore. China has cut off exports. Mine production is flat to declining. Industrial demand is exploding from solar, EVs, and 5G. And suddenly, there's not enough silver to go around. The pie is shrinking. And when the pie shrinks, allies become enemies. It's every bank for themselves. And JP being the most ruthless and best-informed player on Wall Street, saw the writing on the wall before anyone else. They looked at the supply-demand fundamentals, they looked at the vault inventories, they looked at the China export ban, and they made a calculated decision. We need to switch from short to long. We need to stop suppressing the price and start accumulating the physical metal. Because in 6 months, physical silver is going to be worth 5 times what it is today, and we want to own it, not owe it. So they flipped. They closed out their short positions, they went long, and they started demanding delivery. And the first victim of their new strategy was Deutsche Bank, who apparently didn't get the memo fast enough. Deutsche was still playing the old game, still holding short positions, still assuming the cartel would protect them, and JP ate them alive. Now, some of you might be thinking, if JP is accumulating silver, doesn't that mean they're bullish? Doesn't that validate everything we've been saying about the silver shortage? Yes, absolutely yes. This is the single most bullish signal the silver market has ever produced, because JP doesn't make bets. They make calculated moves based on information that retail investors won't see for months. If they're willing to burn bridges with their former partners, if they're willing to drain the COMEX registered inventory to dangerously low levels, if they're willing to trigger a retail panic by buying up all available supply, it's because they know something catastrophic is coming. They know the price is about to explode, and they want to be positioned on the right side when it does. But let's talk about what this means for you, the individual investor trying to buy silver right now. Because while JP is scooping up millions of ounces at wholesale prices through the COMEX, what's happening in the retail market is absolutely devastating. I've been monitoring the major online bullion dealers since the market closed on January 2nd, and what I'm seeing is unprecedented. Complete inventory collapse across the board. Let me give you the specifics. SD Bullion, one of the largest volume dealers in the United States, is showing out of stock on virtually every silver product. American Silver Eagles, out of stock. Canadian Maple Leafs, out of stock. Even generic rounds and bars, the stuff that usually nobody wants, out of stock. And it's not just that they're sold out today. The estimated restock date is listed as March 2026. That's 2 months away. Think about what that means. SD Bullion is telling you that they cannot source silver inventory for the next 60 days, not at any reasonable price. The supply chain is broken, the wholesalers don't have product, the mints can't get blanks, the refineries are backed up, the entire pipeline from mine to consumer has seized up. Kitco shows the same thing. Their silver product pages don't even display prices anymore, just unavailable or notify me when back in stock. Kitco has been in business for decades. They've weathered every precious metals rally and crash, and they're essentially telling customers, we can't help you right now. We don't have metal and we don't know when we'll get more. And then there's APMEX, which is usually the dealer of last resort. They always have inventory because they charge the highest premiums. If you're desperate, you pay APMEX prices. And right now, yes, APMEX has a few Silver Eagles listed as available. But look at the price, $89.70 for a single random year American Silver Eagle. The COMEX spot price is $71. That's an $18.70 premium. That's a 26.3% markup over spot just to take physical possession. And if you want a current year coin in pristine condition, the price jumps to $94.96. Think about that pricing for a second. JP is paying $71 per ounce to take delivery of 4 million ounces through the COMEX. You're paying $89 to buy 1 ounce from APMEX. That's the wholesale retail bifurcation in its rawest form. The banks get the cheap metal because they buy in bulk and they have direct access to the exchange. You pay a 26% penalty because you're small and you have to go through middlemen. But here's what the premium is really telling you. It's not just dealer greed. Dealers are pricing in replacement cost. They know what just happened at the COMEX. They saw JP Morgan drain 4 million ounces. They saw Deutsche Bank get gutted. They know that when they call their wholesaler tomorrow to restock, either the phone won't be answered or the price they'll be quoted will be 5 to 10 higher than what they sold for today. So they're raising prices preemptively to protect themselves from getting caught in the squeeze. The 80 price you see on APMEX isn't what silver is worth today. It's what APMEX thinks silver will be worth when they try to replace that inventory next week. The retail market is already pricing in the coming shortage. The premium expansion is the market screaming at you that the paper price is fake and the real price is much, much higher. Now let's talk about what this delivery spike did to the actual physical inventory in the vaults, because while dealers are running out of product and premiums are exploding, the exchanges themselves are hemorrhaging metal at a rate that is mathematically unsustainable. The COMEX released their daily vault report at 5 p.m. Eastern on January 2nd, and the numbers are absolutely catastrophic. COMEX registered silver inventory 39.4 million ounces. That's down 2.8 million ounces in just 24 hours. Now connect the dots here. Deutsche Bank delivered 6.4 million ounces. JP Morgan and Citi took delivery of 6 million ounces, and the registered inventory dropped by 2.8 million. What does that tell you? It tells you that the metal didn't just change ownership and stay in the vault, it was physically removed. JP Morgan didn't buy 4.4 million ounces to leave it sitting in a COMEX warehouse where it could be rehypothecated or lent out. They took it. They loaded it onto armored trucks. They moved it to their private vault. They took it off the board permanently. That metal is not coming back to market at $71. It's gone. And if you think 39 million ounces sounds like plenty of cushion, you're not doing the math correctly. We just saw delivery demands of 17.2 million ounces over 48 hours. That's an average of 8.6 million ounces per day. If that pace continues, and there's every reason to think it will accelerate, the COMEX has less than 5 days of inventory left before registered hits zero. 5 days. We're talking about the complete depletion of the largest silver exchange in the Western world happening in less than one trading week. And once registered hits zero, one of two things happens. Either the exchange declares force majeure and suspends physical delivery, converting all contracts to cash settlement at whatever price they decide, or the price goes vertical because there's unlimited demand and zero supply. Either outcome is catastrophic for anyone holding paper silver or waiting on the sidelines hoping to buy physical at lower prices. But the collapse isn't isolated to New York. It's happening simultaneously on the other side of the world. The Shanghai Futures Exchange released their inventory data after their first trading session following the Chinese New Year holiday, and the numbers are even worse than COMEX. Shanghai total silver inventory, 681 metric tons. That's down 46 tons in a single day. Let me convert that to ounces so we're comparing apples to apples. 46 metric tons is approximately 1.48 million troy ounces, gone in one trading session. And remember, this is happening in a market that just had export restrictions imposed. The Chinese domestic market is now a closed loop. No silver can leave China. But Chinese industrial users still need massive amounts of silver for solar panels, batteries, and electronics, so they're cannibalizing their own exchange. They're draining the Shanghai vaults to feed their factories. And they're doing it at a pace that will exhaust the entire inventory in less than 2 weeks. Look at the global picture now. COMEX is losing 2.8 million ounces per day. Shanghai is losing 1.5 million ounces per day. That's a combined depletion rate of 4.3 million ounces per day from the two largest silver exchanges on the planet. Meanwhile, global mine production is roughly 2.3 million ounces per day. We're running a net deficit of 2 million ounces per day. The supply is not keeping up with demand, not even close. The buffer is evaporating. The inventories that took decades to build are being stripped in weeks, and there's no cavalry coming to save the day. Mines can't ramp up production overnight. It takes years to bring new capacity online. Recycling can't fill the gap because most silver is used in trace amounts that are uneconomical to recover. The only variable that can adjust fast enough to balance supply and demand is price, and that adjustment is coming. Now, I want to address a question I'm seeing all over social media and in my email inbox. People are asking, if JP Morgan just bought 4.4 million ounces, does that mean they're in trouble? Are they over-leveraged? Are they going to collapse under the weight of this position? The answer is no. And we need to be realistic about this because if you misjudge the enemy's strength, you'll make terrible strategic decisions. Let's do the math. JP Morgan took delivery of 4.4 million ounces at roughly $71 per ounce. That's a total cost of $312 million. Citigroup added another 1.6 million ounces, or about $113 million. Combined, these two banks spent approximately $425 million to execute this raid. Now, $425 million sounds like an enormous amount of money. To you and me, it's generational wealth. But to JP Morgan's total Tier 1 capital, their safety buffer, is $1.65 trillion. Citigroup holds about $240 billion in Tier 1 capital. So the $425 million they spent represents 0.023% of their combined capital base. It's a rounding error. It's the financial equivalent of you buying lunch. This trade does not threaten their solvency. It does not trigger margin calls. It does not put them at risk of failure. They have the balance sheet to absorb this position 100 times over without breaking a sweat. So if you're waiting for JP Morgan to collapse because they had to spend $300 million on silver, you're going to be disappointed. They're not the dumb money getting squeezed. They're the smart money doing the squeezing. But here's what's critical to understand. While the financial cost was trivial for them, the strategic signal is deafening. If $312 million is just pocket change for Jamie Dimon, why did they do it? Why did they burn their relationship with Deutsche Bank? Why did they drain the COMEX registered inventory to dangerously low levels? Why did they trigger a retail panic by buying up all available supply? Because while they have infinite dollars, they know there's finite silver. They executed this raid not because they had to spend the money, but because they had to secure the metal. They understand that the $312 million they spent today bought them 4.4 million ounces. But they also understand that next month, that same $312 million might only buy them 2 million ounces. And 3 months from now, it might not buy them anything because there's no metal available at any price. This is the banks front-running the repricing. They're converting their worthless fiat currency, which they can create with a keystroke, into the only physical commodity that every major industrial economy needs and cannot function without. They're not stupid, they're not panicking, they're cold, calculating predators who saw the fundamentals shift and adjusted their position accordingly. They were short when it made sense to be short. Now they're long because it makes sense to be long. And they're using their size and access to crush anyone who didn't pivot fast enough. Deutsche Bank was too slow. Deutsche is the cautionary tale. They stayed short while JP Morgan went long, and now they're bleeding inventory to cover positions they should have closed months ago. This is a war, and in war, hesitation gets you killed. So what does this mean for Monday, January 5th, when markets reopen after the weekend? What can we expect in terms of price action, delivery demands, and inventory levels? Let me give you my analysis based on the current trajectory. First, expect continued high delivery demands. The entities that stood for delivery on January 1st and 2nd are not done. They're going to keep pressing. They're going to keep demanding physical metal because they know the window is closing. Every day that passes, the China export ban becomes more entrenched. Every day that passes, the inventories get lower. Every day that passes, the risk of a force majeure declaration gets higher. So the smart money is going to accelerate their accumulation, not slow it down. I would not be surprised to see another 5-8 million ounces of delivery notices posted on Monday and Tuesday. Second, expect the registered inventory to continue dropping precipitously. We're at 39.4 million ounces now. By Wednesday, we could easily be below 30 million, and once we break below 25 million, which is less than 2 days of current demand, the alarm bells are going to start ringing loud enough that even the mainstream media can't ignore it anymore. At that point, the COMEX will have to make a decision. Either raise margin requirements dramatically to slow demand, or declare force majeure and suspend deliveries. Third, expect the physical premiums to continue expanding. Right now, we're at 18, 19 ounce overspot for retail Silver Eagles. By next week, I expect that to be 22, 25. And by the end of January, we could easily see $30, $40 premiums as dealers either run completely out of stock or price themselves at levels that reflect true replacement cost plus risk premium. Fourth, expect increased volatility in the paper price. The banks that are short are going to fight. They're going to try to smash the price with coordinated selling of futures contracts to trigger stop losses and shake out weak hands. You might see violent moves down to $68 or even $65 on the COMEX, but watch what happens in the physical market when they do that. The premiums will expand even further. The disconnect will become more obvious, and the smart buyers will use those dips to accumulate even more aggressively. Fifth, expect mainstream media to finally start covering the story. Up until now, the silver shortage has been relegated to alternative financial media and precious metals forums. But when COMEX registered inventory drops below 30 million, when dealers are sold out for months, when premiums hit 25, 30, Bloomberg and CNBC are going to have to acknowledge that something's wrong. And when they do, when they finally tell the general public that there's a silver shortage, that's when the real panic buying begins. That's when your neighbor who's never thought about precious metals suddenly wants to buy some. That's when the demand goes truly exponential. Sixth, watch for potential government intervention. History shows us that when commodity markets dislocate this badly, governments step in. In 1980, the COMEX changed the rules mid-game to stop the Hunt brothers. They instituted liquidation-only trading where you could only sell, not buy. They raised margin requirements to 100%. They destroyed the market to protect the banks. We could see similar moves this time. The COMEX could raise margin requirements on silver futures from the current 15% to 50% or higher. They could impose position limits to prevent any single entity from accumulating too much. They could declare a market emergency and suspend trading entirely for a cooling-off period. All of these tools are in their playbook, and if the shortage continues to intensify, they will use them. But here's the thing. None of those interventions solve the underlying problem. You can change the rules on the futures exchange all you want. You can halt trading. You can raise margins, but you cannot print silver. You cannot make 100 million ounces of silver appear out of thin air. The physical shortage will continue regardless of what games they play in the paper market. And eventually, the paper market becomes irrelevant as all pricing shifts to the physical market where actual metal changes hands. Let me give you the bottom line reality check. We are in the early stages of the most significant commodity squeeze since the oil crisis of the 1970s. The fundamentals are overwhelming. Supply is constrained and getting worse. Demand is exploding and accelerating. Inventories are being drained at unsustainable rates. The largest banks in the world are fighting each other for control of remaining supplies. Retail access is evaporating. Premiums are expanding. And we're only 3 days into 2026. We have 362 days left in this year. And based on the current trajectory, based on the mathematics of supply and demand, based on the evidence of bank behavior, I believe we're going to see silver prices that seem impossible from today's vantage point. My conservative target for silver by the end of Q1 2026 is $135 per ounce. That's a 90% increase from the current $71 paper price. But if you're buying physical at current retail prices of $89, you're only looking at a 52% return. Still excellent, but not the moonshot some people are expecting. My moderate target for end of Q2 is $180-$200. At that level, the industrial users will be in full crisis mode. Production lines will be shutting down, governments will be invoking emergency powers, the media coverage will be wall-to-wall, and retail investors who ignored the warning signs will be panic buying at any price. My aggressive target for year-end 2026 is $250-$300. At that level, the gold-to-silver ratio will have collapsed from the current 37.1 down to 15.1 or lower, which is the historical norm. Silver will have caught up to decades of undervaluation relative to gold, and the paper pricing mechanism will be completely discredited and abandoned. But here's my wildcard scenario, the one I don't like to talk about publicly because it sounds insane but is mathematically possible. If the COMEX declares force majeure, if China continues to lock down exports, if a major industrial user announces production halts due to silver shortage, we could see a genuine no-offer market. That means there are buyers at any price, but no sellers willing to part with their metal at any price. In that scenario, silver doesn't go to $300 or $400. It goes to whatever number is required to shake loose supply from existing holders. That could be $500. It could be $750. It could be higher. We've never seen a true supply shock in a commodity that's both industrially critical and monetarily significant in an era of unlimited fiat currency creation. We don't know where the top is because we've never tested it. The Hunt brothers got to $50 in 1980, but that was in a completely different monetary environment. Today, with central banks printing trillions, with China and Russia de-dollarizing, with industrial demand exploding from green energy, the ceiling could be much, much higher. So what should you do right now? Let me give you concrete action steps based on where we are on January 3rd, 2026. First, if you own physical silver, do nothing. Don't sell, don't trade, don't try to be clever and time the market. Just hold. Your metal is your insurance policy and your ticket to the revaluation. Every ounce you own is an ounce that JP Morgan can't use to cover their position. You are the resistance. You are the immovable object that prevents them from controlling the entire supply. Second, if you have silver in paper form, ETFs like SLV, unallocated accounts at banks, digital silver on apps, convert it to physical immediately. I don't care if you have to pay a $20 premium. I don't care if delivery takes 6 to 8 weeks. Get out of the paper system before it collapses. Because when force majeure hits, your paper claim gets settled in cash at whatever price they decide, probably the suppressed COMEX price, while physical holders keep their metal and watch it appreciate to real market value. Third, if you have capital on the sidelines and you've been waiting for a pullback, stop waiting. The pullback isn't coming, or if it does come, it'll only be in the paper price while physical premiums expand to offset it. You're not going to be able to buy Silver Eagles for $75 again. That opportunity is gone. If you can find metal at $90.95 today, that's probably a gift compared to where prices will be in 60 days. Fourth, diversify your metals holdings if you haven't already. If you only own silver, consider adding some gold for stability. If you only own gold, consider adding silver for upside leverage. And if you're really sophisticated, look at platinum and palladium, which are even more suppressed than silver and have their own supply issues. Fifth, prepare for extreme volatility and stick to your strategy. There will be days when silver drops $5 an hour. There will be margin hikes, rule changes, media attacks calling it a bubble. All of that is noise designed to shake you out. Ignore it. Focus on the fundamentals. Supply is falling, demand is rising, inventories are depleting. That's all that matters. Sixth, educate yourself and share this information. The mainstream media is not going to warn people until it's too late. They're not going to sound the alarm until after the retail supply has evaporated. It's up to the alternative financial community to get the word out. Share this analysis. Explain the fundamentals to friends and family. Help people understand what's happening before they get crushed. Here's the final truth that I need you to understand. What we witnessed in the first 3 days of 2026 was not an anomaly. It was not a temporary spike. It was the beginning of a phased transition. We went from a market where paper and physical were loosely coupled to a market where they're completely decoupled. We went from a market where the banks work together to suppress price to a market where they're fighting each other for survival. We went from a market with adequate inventories to a market facing genuine shortage. We went from a manipulated market to a free market. And free markets, when they're dealing with a commodity in structural deficit, only know how to do one thing: ration through price. The price has to rise until either supply increases or demand decreases enough to reach equilibrium. But supply can't increase quickly because mines take years to develop, and demand can't decrease because industrial users have no substitute for silver in most applications. So the price has to rise dramatically, shockingly, to a level that seems ridiculous from today's perspective, but will seem obvious in hindsight. We're living through a historic moment. The silver market is breaking in real time. The 46-year record for delivery demands just got shattered. A major European bank just got eviscerated by their supposed allies. The retail supply chain has collapsed. Exchange inventories are in free fall, and we're only in the first week of January. The rest of 2026 is going to be absolutely wild. There will be fortunes made and lost. There will be defaults, bankruptcies, lawsuits, regulatory interventions, and potentially even government seizures. The system is not equipped to handle a genuine commodity shortage in a globalized, financialized economy where everything is leveraged and nothing is backed by physical assets. We're about to find out what happens when paper promises collide with physical reality. And I can tell you this with absolute certainty: physical reality always wins. Paper can be printed, contracts can be voided, rules can be changed, but atoms are atoms. Metal is metal, and if you have it, you win. If you're waiting for a better price, you lose. The train is leaving the station. JP Morgan is already on board with 4.4 million ounces. Are you? This is the final call. This is your last clear warning before the chaos truly begins. Position accordingly. Stay safe. Stack physical. And I'll see you on the other side of the greatest wealth transfer in modern history.